Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Drew and Meredith, welcome to the Australian Investors Podcast.
Excited to be here as always.
Oh, very excited, good sir. Where are you joining us from this week? It seems like every week you're somewhere new.
Same place last time.
Oh, really? You're at the beach house?
I am. We've lined up a series of trades and removalists, deliveries all at the same time, electricians, plumbers, gardeners.
At which point does it not become your beach house? Like, how much do you have to be there for it, like, to not to be the beach house and to be your actual house?
It's a family beach house. Let's disclose that too.
Sorry, Dad.
50-50? Do you reckon it's 50-50?
Yeah, but I don't know. What does the ATO say?
I mean, if you're not renting it out, well, you're paying vacant residential land tax on it too.
Victoria.
Yeah, that's when it's not a beach. That's when everything's not a beach house, I'm pretty sure.
Yeah, particularly down on the peninsula. It's
stunning day today, though.
Yeah, worth it. There's some serious land tax in Victoria. I got to admit, like, it's wild.
I've been meeting a few clients today that all have their own investment properties, every single one of them in a different state to Victoria. And everyone looks at us and goes, what is happening? It applies from $0. If it's not rented for a period of time, you get all these additional taxes on it. Valuations have been going up, even though the property market's now flat. It's hard to see, land tax valuations reducing if the property market reduces either. So it's becoming more and more costly. It's interesting down here because there's a lot of houses for sale and have been for sale for a while, and then there's a lot of construction at the same time.
Yeah,
seriously, lots of construction.
It's interesting because, like, if you don't rent it out, then you get vacancy tax. If you do rent it out, then you get Airbnb tax. You get, like, all these other additional things, and it's like, obviously the only answer is sell it. Because
then someone pays stamp duty on the other side. So
yeah, then there's that place which you probably are aware of. This place called Millionaire's Walk down in Sorrento, connects Sorrento in Victoria to Portsea. Yeah. For anyone that's not ever heard of this place, it's like down near, like, where the bottom of the Port Phillip Bay meets the ocean.
Beautiful.
Yeah, beautiful. And there's a place called Millionaire's Walk, and you can Google it, and you can just walk through people's back/front yards. It's like a public walkway, and it just kind of looks like a footpath that the families would use. But you go past on the cliff top all of these amazing houses. And when I, naturally being a finance dude, when I go past there and I do that walk, I look at it and I'm like, oh, I wonder what this house is worth. When was the last time it sold? And many of these houses, let's bring it up here for people watching on YouTube, Millionaire's Walk in Sorrento. When you walk,
the fang still there.
Oh, I just had a bit of fang going on. Don't worry about that. When you go past this walk on the cliff tops, you find that many of the houses haven't sold for like 30 years, or sometimes longer, because they're like in the family. They stay in the family for decades.
Just noting that we do not not have a house on Millionaire's Walk.
Hey, look, there's a picture of Drew. But yeah. Anyway, back to the FANG ETF. You still hold it?
Still hold it. How's it going now?
Look at that, mate. 140% in 5 years.
What about the year to date? I think it's not a strong year to date.
20%. Downwards trend recently. What are your candlesticks?
Head and shoulders pattern for sure.
Yeah, for sure.
Just waiting for a positive breakout.
Bit of dandruff. Those are some. That's some inside baseball jokes for people that didn't study finance. You wouldn't know that technical analysis people use those types of terms that we just came up with. We're not just talking about like an ad for Pantene. Just so you're aware, it's as silly as it sounds, it is what they do. What has been making news? And you said you've been talking about clients and that sort of stuff, some investment properties. What have you been up to?
Oh, a bit of everything. I've had a few fund manager meetings this week, which are pretty insightful. Some good insights. And yeah, we're in front of clients multiple times a day. So understanding where the questions are coming from and kind of getting an insight into what people are worried about in the lead up to retirement.
What are they worried about?
I mean, there's opposite questions. There's some people are worried, can they retire? How much do they have enough? Others are a bit earlier, and how do they get to how they have enough? And then the other ones are like, how do I not stuff it up? Well, you can use a different word, but this is a PG podcast from my understanding. Literally had that conversation today, which is how do we not stuff it up? And that's, there's a massive, not disparity, there's a spread of different types of advice. Some of it is focused on getting the strategy, tax, cash flow planning. Quite a few people using Pocketsmith, which was kind of interesting in almost every.
Oh, really?
Yep.
Really?
Yeah, Pocketsmith, which is good. People getting control of their cash flow.
I bet that makes your job easy.
Yeah, definitely. Like we always have the question how much you need in retirement. Most people have no idea. So we make an assessment. We have a pretty good understanding. We know this gold and silver legacy years, how much you're likely to spend in each portion. And we can kind of frame that for people. But if they've got something like Pocketsmith already ready to go and they're tracking their expenses, you can easily say, well, remove your mortgage payments, remove your insurance. This is what it's going to look like in retirement. So definitely a better place to start from. Otherwise, you're doing sensitivity analysis. What if you spend 80, 100, 120,000? How long does your capital last?
That's interesting. So full disclosure, Pocketsmith is our newest long-term advertising partner on the Rask network. And we've started using it recently, like as in Casa del Rask here at Rask headquarters. We're using Pocketsmith as well. It was interesting because I always thought, oh, well, maybe it's limited. Like maybe I can't track like Amex, which is where we do a lot of our spending. And like we just changed mortgage providers, like we moved to NAB, away from Bank of Melbourne, but we still use ING for some transactional stuff and for like our fund money, or as Barefoot would call it, the splurge account. So we've kind of got like shit all over the place. PG podcast. Just went to M. It's going to be MA before the end of the show, maybe R-rated. But yeah, like we have stuff all over the place, and Pocketsmith handles all of that. So I was like, well, that's cool.
Yeah, Open Bank is made a lot easier for that. Similar to like MyProsperity, which we use.
Yeah.
Where you can get all those things plugged in regardless, and sometimes it's too much information, and you need less. But it's, definitely helpful. The more informed and aware people are when they come in, the easier it is to help. And job's supposed to be easy. And then life changes too. So part of the advice is about dealing with when it changes, not, we don't spend the same amount all the way through retirement.
Hey, you know what was really cool? We're recording this on Wednesday, the 2nd of October, so a couple of days in advance. I was doing the monthly numbers for Rask and just looking back over the month that was September. And on YouTube, the Australian Retirement Podcast in its first month has had more listeners or like more viewers and more views / downloads than the Australian Business Podcast and the Australian Property Podcast combined. So,
not to brag.
Look at you go, mate. Look at you go. You and Mr. O'Reilly. It's just that electric chemistry that the two financial advisors have.
It's hard to get in financial advice, isn't it? And we're only just getting started with that too. So we've obviously done a few kind of, broad-based 101 episodes. And then we'll start to get into bringing external guests in, including your humble self as well.
What am I doing?
Expert. Better expert coming in on interest rates.
Interest rate predictions.
Yeah.
Yeah. You bring me in, set me up, stitch me up, just like I stitch you up. That seems fair. James will be like, what the heck are you guys talking about? But
and John Glass recently, and we're reaching a lot of guests and trying to appreciate any ideas on guests as well.
Yeah, there's been a lot of questions come in for that series already. Just for anyone that is unfamiliar with the Australian Retirement Podcast, it launched about a month ago now. And it's one episode a week until episode 10. So the first 10 episodes, like the essentials of pre-retirement and retirement itself. So you can head on over. It's in Spotify, Apple Podcasts, Castbox, YouTube, all those places. So if you're interested, it's been really successful. I think the first episode's already had something like 8,000 people tune in. So huge, mate. Huge numbers. Well done, straight out of the gate. Still not as big as the Australian Investors Podcast.
Never.
Dare I say. But, it's great, mate. So well done. What else has been making news? We've got a lot of questions for today, but what else has been making news?
I'm having a lot of conversations that are, people are worried about, and I've been asked to write an article on this as well, on the way advisors are kind of portrayed in the media, which is an interesting one. There's a perception that bigger is always better. Like a big bank, a big super fund's always going to be better, regardless whether it's performance or anything else. We're going through those kind of questions a lot. And then there are probably some really interesting on the economic investment side, had some interesting takeaways from a couple of meetings this week too. One's on the big, not just CBA, but the banking sector. And there's probably some good portfolio considerations in that too. We caught up with you interviewed Dion Hershen, I think, recently.
Oh, Dion. Yeah.
We caught up
X20.
Yeah, in the week and more broadly on some of the insights into the market, both the top 20 and outside the 20 was pretty interesting. Like, I think you've talked about CBA and it being so, everyone's seeing it as expensive at the moment. And they say that something like 100 billion has been added in value in the banking sector in 10 years, but only 100 million has in increased profit.
Wow.
And so generally, I think you wrote an article on this too, your share price tracks your earnings. Like something like Microsoft and Apple, you can see it tracking earnings. But when you look at the banking sector, it's been multiple expansion, at least 35% over the last 12 months. And the interesting part was the takeaways and what were the things driving it. And there's multiple. Some of it is just reinvest when you're reinvesting into an ASX 200, you get it automatically getting 10% in CBA and something like 32% in banks. Not saying there's anything wrong with it, and we're not selling CBA by any means. But there's other things like the incremental buyer for the index has changed significantly. So something like Your Future, Your Super, which has forced super funds to focus on not underperforming the benchmark, means a lot of them are tracking back towards the benchmark. And then a lot of underperforming active managers are being forced to go back towards the benchmark too, which means they're kind of momentum drivers of share prices in the sector. I thought that was like super interesting. And it just it's something we're focused on for this quarter is finding the pockets of opportunity. So not throwing the baby out. I'm really bad at these old fashioned kind of things. But finding the pockets of opportunity. So probably, and everyone knows the ASX is an all-time high, the S&P 500 is an all-time high, gold's an all-time high, all these asset classes are an all-time high. So where's the incremental dollar going to go that helps build resilience away from that? And I think that's what one of the questions was from this week too, I think. Yeah.
We will get to that in a sec. Actually, you touched on something before you started talking about CBA. Jamie actually sent us a text message the other day being like, everyone's saying that CBA is such a bad investment, like all these brokers have sell alerts, but the thing just keeps going up. And I think one of the big reasons for that is like money just keeps piling into the ASX, like you said, through dollar cost averaging.
Yeah.
Every month, Australia as a whole saves 10% of its wages. And where does Australia's 10% of its wages go? Well, into super funds. And what do? Mostly, a lot of that just goes into Aussie shares. So, like, in the absence of any other idea, Australian super is going to buy CBA every other month. So,
and anyway, it was weight CBA, which a lot of people have been forced to increase their weighting back towards the benchmark. So, and it could be a trend that sustains. It could be one that turns. There's different reasons it might turn. Commodities are becoming more attractive with what's happened in China in the last couple of weeks. So it could be a rotation. And this is a reminder that all equity funds have to remain fully invested all the time. So if they're not in CBA, they have to go somewhere else. And which part of the markets is that going to go into?
Before you started talking about CBA, you did mention something about writing an article for the industry. Someone who didn't leave a name in their question, wrote in and said, after finishing high school, is there any finance internship programs? I wanted to call this question out, even though it didn't come with a name. The reason being is that I've been chatting to some financial advisors, Drew, and I actually think the financial advice profession has just had a huge clean out and is about to get way better in terms of the way it presents itself to society. And it deserves to, because the people that have hung around are good financial advisors who can genuinely help you, have a code of ethics. Obviously, I'm biased as anything because I'm currently studying financial planning ethics at uni. But I actually think that the whole profession is going to come out as a profession, and we're going to see that realistically this is something that you can trust, and financial planners are good again. if that's like, I know there's been a lot of history with banks and, big institutions. Bigger is probably not better when it comes to financial planning. But I wanted to do a particular shout out for anyone that is in uni, studying financial planning, or thinking of going back in and studying financial planning, or you already have a related degree and you want a job in financial planning. Please reach out to me, because I know heaps of financial planning firms that are looking for talented people. Even if you're not a financial planner, maybe you're in that client service, like maybe you're in a role where you know a bit about finance and you're willing to study. A lot of the really good, fast-growing financial planning firms are happy to employ you and get you to work with an advisor as an associate or in the background and dealing with clients while you go through your professional training. And like Drew here, you have a team of people that aren't financial advisors but are still developing their skills and still growing. There's so many good opportunities out there for people.
We had an intern turn into a full-time employee probably 6 months ago. We've had 2 other interns as well. So we're always open to it. And it's not the internship it used to be. Financial advice used to be like mailing, licking envelopes or doing paperwork. These days, you can be straight into the kind of nuts and bolts of advice, and you get exposure to clients, to investments, to everything quite quickly, at least in the way we do it.
I can just imagine you licking a bunch of stamps and envelopes. Hey, Drew, lick this one. It's for Betty down in Manage Island.
I mean, with the CBA comment in mind, I had a question for you, which was, we've been focusing a bit on interesting stock picks, or last week was what's going to triple, and you're pretty boring when you agreed with Macquarie. So if you think about and this probably kind of relates to X20, but not specifically. Mm-hmm. If you think, the likes of the top 20 are pretty narrow. They're in iron ore, they're in banks, and the banks done incredibly well. They're expensive or overvalued by every measure. Mm. What are the best ASX stocks to diversify? Even if you're using BAS, you're in a pretty concentrated core. If you were trying to add some diversification, you can probably get me an ETF if you want to. But what are the more interesting ones to diversify at the moment?
Well, this is. Have you ever followed the ASX? It's a relatively new index, the ASX S&P All Technology Index. Have you come across this?
I haven't. I know it was launched in the middle of the pandemic, wasn't it?
Yeah, and this is when it had like Afterpay and all this kind of rubbish in it. But more recently, this is up
27% this year.
Yeah, this it's actually been really, really, really impressive. So when this launched, I was like, surely like companies like, our tech companies don't compare. And we only had 39 in the index. I'm just showing it on my screen for people that aren't familiar. So 39 stocks is what it had in it at the end of June 2024. But companies in there like Block, WiseTech, REA Group, Xero, Computershare, Promedicus, Car Sales, NextDC, Altium, Seek. Like Altium's no longer in there; they got bought out. So, and it's performed exceptionally well since its inception. And I think if you're looking for a portfolio diversifier and you want some tech, I think this is a way to go. But I think if you were to do this, you're gonna. I don't think there's an ETF that tracks this. So if you're an ETF provider listening to this, I'm sorry if you do have one, or if you don't have one, you should probably have one of these. I think the thing that would probably, just so people are aware, if you bought this, you would be swapping expensive for more expensive, because some of these stocks like Promedicus has a PE of infinity. Who knows what WiseTech is? BlockPro doesn't even have one.
BetaShares has ATEC.
Oh yeah, ATEC. So what does ATEC track?
ATEC tracks the All Tech Index.
Oh, so it does. Okay, yeah. So it provides exposure to this. So, sorry, BetaShares.
0.48%.
0.48%. Yeah, well, something like this is an interesting way to cut up the Australian market. So there you go, WiseTech at 10%, Xero at 10%, Car Sales, NextDC, Life360, like a lot of technology one, a lot of great companies in there, which I think for a long-term play, it's definitely not a value tilt. These types of things are really interesting. I think another one that's quite interesting, is it the VanEck ASX 50 or like mid-cap 50? Is that what it's called? Yeah, MVE. Have you come across this, Drew?
Sorry?
this one, the VanEck S&P ASX Mid Cap ETF, MVE.
Yes.
This
there's
is pretty...
an X20 index as well.
Yeah, so there's X20 from BetaShares, which is literally X20 is the ticker symbol. And then there's VSO from Vanguard, which is very similar. But then there's this one, which is MVE from VanEck. 0.45% is the management fee. This one is, I think, it's the mid-cap 50 represents the mid-cap universe. So it's everything in the 100, excluding those in the 50. So you're getting 51 to 100.
Yep.
And I think that's like a really interesting part of the market, because if we go down, we've got Car Sales, NextDC, REA Group, Promedicus, Evolution Mining, JB Hi-Fi, Orica, Seven Group, Vicinity, Solpats, Endeavour Group. But I've got a question for you on the back of this. I know you asked me a question. These are kind of my answers. Like a lot of the, by the way, these are the ETF equivalents of the answer to your question, but there are a lot of individual companies in there, like Technology One, Washington H. Soul Pattinson, even Vicinity Centers. These are
sectors and property sectors.
Yeah, I'd say that's a really, if you just had that as an index, that would be really good.
Yeah.
But I've got a question for you. I'm interviewing Invesco. I think it's tomorrow. And the conversation that we're going to be talking about is they run a quant fund. Obviously, Invesco run quant funds and multi-factor funds.
Australian
smaller companies. So we're going to be talking about using quantitative strategies to invest in small and mid-cap companies in Australia.
Yeah,
they have this slide in the pitch deck which was sent to me, which is some of the small cap indices, like the traditional indices, are biased. You don't actually get what you think, because the best companies get promoted out of the small cap indice and go into like the ASX 200 or 100 or whatever. So they leave your ETF or your index before they do a lot of their really good work.
Right. Yeah.
And by contrast, in the small cap indices, you end up capturing, like you catch on the way down, all the dog companies, all the crap that kind of falls out of the ASX 200. So I'm curious how you think about this. Like, for a small or mid-cap Australian equities portfolio, like you're talking to, what's his face from Yarra, Dion Herson.
Yeah.
Would you, if you're looking at mid-cap Australia, would you be more inclined to do like a multi-factor or a factor strategy or an active strategy, or and just avoid index entirely? Is that how you approach it?
So we tend to use both. So we've used the Invesco, and Atchison used the Invesco fund as well. But I think what you talk about there is the style bias that comes through. So if you're getting in, style is like your value, your growth, your size, your dividend yield. And what Invesco is talking about is, if a company is falling out of the high of the larger caps, then it's likely a value company, because its earnings are falling or it's looking cheap, and you end up having a lot of mining and cyclical companies. So your portfolio naturally tilts to that in smaller companies, and it tilts away from growth because all the growing companies are getting bigger and they're leaving the benchmark. So we know, and the data shows that more than 50% of active managers in smaller companies and in mid-cap companies outperform their benchmark.
Yeah.
So we tend to try and use both. And something like, there's a couple of X20, but something like the Yarra X20 is interesting for that. And continuing on that is that what we're worried about is making sure we're not exposed to those factors as well. So if you just flat out bought the index, you're going to get a style or a sector exposure. We at the moment, and our preference is to have a style neutral exposure to that part of the sector, which means you're not overweight to miners, you're not overweight to tech companies. You've got a blend of both. So if the economy turns, if rates turn, if any major events happen, you're going to have some level of diversification against those events.
Yeah, fair enough.
A style matters, and it's probably a less understood influence of share market returns.
Yeah, for sure. All right, you've got I saw, I can see I've got Bloomberg playing right here. Brent crude up 1.55, natural gas up 70 basis points. We also saw that gold has started rallying
again.
Yep. This past 3 or 4 days, at the time of recording, we've seen Iran firing missiles at Israel, Israel firing missiles at everyone else. Like, not to make light of it, it's not like from a humanitarian point of view, it's like it's 2024. You'd think the world can move past a lot of this stuff, but here we are. And that has implications, Drew. These types of geopolitical events, quote unquote, have implications for the stock market, for bonds, for currencies, for commodities. Like, how do you make sense of that, and how do you build a portfolio?
I think most people look beyond it as much as they can. Like, there's short-term events, and this has been these issues, and there's always issues that have been going on for 20 or 30 years, and everyone's always worried about how it expands, and now, like in Iran getting involved, is it expanding? And you see the natural reaction. Oil prices go up because they're oil-producing nations. Currency, the US dollar tends to rally, and gold tends to rally because people look for real assets rather than equities in this environment. And I think most of the data shows like the economic and market impact of companies like Apple, Microsoft, CBA is very limited from these types of events, but the sentiment is what has the biggest impact on the market. And for us, it's boring, and I keep talking about it this week. It's conservative in that you just want a portfolio that's resilient to this. If it's going to have an impact on oil prices, which is then going to have an impact on the cost of airfare, there's the flow-on effects of that. You just want to make sure you're never overly exposed to one of these risks, and it probably increases the value of hedges. So we've had gold as a hedge for a long period of time, and no one likes a hedge when it's underperforming, and it increased. But this is exactly when the hedges tend to pay off. That the share market might fall for a week or longer, but you've got some assets, could be infrastructure, could be oil and gas companies, could be gold, that supports the portfolio during that period.
Okay,
protects the capital.
So you know how you often give me like an over or under, right?
Yeah.
So in 1 year, according to goldprice.org, it looks like the website was built before the internet, but in 1 year, according to goldprice.org, the gold price is up in US dollars, Drew, 46%. So you're a happy little beaver over at Wattle Partners there.
Change it to AUD, please.
Yeah, okay. Wait. So this is my game. I'll change it to AUD in a second, but I'm going to change it to something else in a second. And you have to pick over or under. Is it more than USD gold? So USD gold, for everyone, just a refresher, 46% over the past year. Now, if I change this to United Arab Emirates dirham, is it over or under a 46% return in 1 year?
Oh, it'll be like 200%.
All right, here we go. Changing it to AED.
Oh, under.
It's 46%.
Oh, that's probably because the dirham is probably US dollar, isn't it?
Okay, let's go one more.
Pegged to the US dollar.
Okay, here we go. We're going to go for the Aruban florin. I didn't even know that was a currency or a place.
That'll be pegged to the US dollar too. You're trying to stitch me up here.
Oh, it's 46% as well. Okay, so wait.
Currency pegged.
Okay, wait. The Brazilian real. They do everything themselves. So
they don't.
Gold in Brazilian real, however you say this.
46%.
You reckon?
Yeah.
56%. 56%, 55%. Okay, surely what about the Bhutanese Mgaltram? Here we go. Last one. 40. Okay, yeah, they're all bloody tied to the US dollar. Okay, moving on.
What's the most important one? What's the Aussie dollar done?
What's the Aussie dollar done? So Aussie dollar gold, here we go. It is 34%. So not quite as good. However, Drew, this is going to be my question for you. I just jumped off a discussion with Cameron Gleeson, who's a senior investment strategist at BetaShares, and we were talking about the QAU ETF, which is the largest currency hedged gold ETF in Australia. Over the next 12 months, do you think that a currency hedged gold position will do better than unhedged? So just for people's context, gold is always priced in US dollars, which is why when you invest in a standard gold ETF, it benefits from the currency if the Australian dollar depreciates. But if the Australian dollar goes up, Drew, and the gold price stays the same, if you're in one of those normal ETFs, you're going to lose. when you transfer the money back. So do you think that it's time to have some currency hedged gold?
I think the RBA would react pretty quickly to the Aussie dollar rallying too strongly. So I think it wouldn't surprise me if they track pretty closely to what they are at the moment. I think, if I've got a lot, if 10% in Aussie dollar gold, then I'd be looking to hedge some of it. But if it's more reasonable exposure, I wouldn't be too worried about currency yet.
Okay, because the Aussie dollar is nearly 70 cents US.
Yeah, it's gone. That's where some of that return has disappeared in the last 12 months as well. But you'll see, like, the Aussie dollar strengthening too much it becomes a problem for the Australian economy as well.
Yeah. Your retiree clients are going to be like, what or who? They're going to be overseas in Europe sipping on some really nice red wines in Tuscany before you know it, because they've got their currency. They're going. Yeah. They're going. You've invested well, Drew. Thanks very much. But I'm going. I'm going to take it. Yeah. So, okay. Final question before we get to the actual questions. Best ASX stocks to diversify a concentrated core, Drew.
This is my question to you.
But you got the companies there.
So I've got a few here. So, and these are pretty close to our model. And what you're seeing is a kind of, you've used one of them, which is tech, but you're trying to find the sectors that aren't being overly allocated to in that core at the moment. So, you're getting heaps of iron ore miners, you're getting heaps of banks, and you're getting a little bit of healthcare. Yeah. And then the rest of it, grocery retailers, and they all, fall off pretty quickly. So I'm looking at healthcare. ResMed it's been in the news a lot. It's had a nice little recovery lately, but there's a number of other high quality healthcare companies that fall in there. Property, which we talked about last time. Big thing in property when we went through that was that you want to buy things that are trading below their NTA. A lot of them, even Vicinity, starting to get close to its NTA. So which parts of the property sector? We've talked about Dexus, I think, before. Yeah. Data centers, interesting as well. Obviously, the valuation on something like Goodman's very different. Industrial companies. So we've liked a company called Cube, old Patrick Ports, for a long period of time. But these are all economically sensitive, but completely, if you bought the index, you're getting like 1% of your portfolio in that. So how do you start allocating to different parts of the economy? There are a couple of examples that I've pulled out.
I think if you just take the standard Aussie market, you get, like you said a few times now, you get a lot of banks and a lot of miners.
Yeah.
So what are the other areas that you probably want? Most Aussies are already exposed to property through their residential property or through their business if their business owns a property. So there's really no added benefit, in my opinion, from adding a lot of property. I think that maybe a lot of the added benefit does come from things like healthcare. You mentioned ResMed, Cochlear, these types of businesses, but also global healthcare, global infrastructure. I think those types of areas are really interesting. Like you mentioned gold as a commodity hedge. We don't have any gold at the moment, but that's because rates are high, and I just don't think that we need it. I think there's more protection in government bonds than there is in gold, even though gold has performed very well.
Yeah.
So, it's interesting. I kind of agree with you. The Cube's quite an interesting one. I didn't expect you to say that. I know you were a big fan of Boral for a while.
Fits more in the mid-cap space, but it's returned well for us over a long period of time. And it's one of those companies that always looks expensive as well.
Yeah. There was a question that come through, and I think you sourced this from the Rask community. That's at community.rask.com.au. We'll start to get a lot more questions from there because there is a retirement channel there. So if you want to chat to anyone about retirement, head to community.rask.com.au. It's free to create an account.
And trawling it for questions for the podcast.
Trawling it. I was trawling it before we hit record, and I was like trawling it /alarmed at some of the things. I was like, whoa, I need to put a lid on this one over here. But the question, I don't know who the questioner was, but you've pulled it out and it says, what options exist for people, e.g. nearing or in retirement, who might want something a little more than a typical super fund, a default super fund, i.e. a tiny bit more control plus some of the so-called benefits of an SMSF, but don't want or need the hassle of actually having an SMSF, nor the need or desire for complete control? A lot of the big super funds allow you to DIY your own mix sometimes. Like you can pick like index strategies or active or
some direct stocks, but then you're kind of doing it without any support there too, aren't you? And you're limited and you don't necessarily have a structure.
Yeah.
There's three types of super
funds. Yeah, big fingers there. Yeah.
My TikTok, just make sure you mix a lot. Motioning with his hands.
Getting handsy.
You got your industry funds, which are fully outsourced. Basically, you barely know what's in there, and they're managing it for you. They've managed it incredibly well. The other end, you've got SMSFs, where you get to control everything. You can use an advisor to help, to execute, to do all that, and get rid of all the admin work as well. But it's full control, full transparency. Mm-hmm. And there's a growing range of options in the middle. Everyone would have heard of like a Mercer or a Plum, these kind of corporate super plans. They're probably more like an industry fund in terms of limited options. But then listed stocks, Praemium, Net Wealth, Colonial First State, Hub24, all these groups are what's called a super platform or an investment platform. And they're a wrapper that gives you the benefits of an SMSF and the benefits of an industry fund. So you can pick, with the help of an advisor, wholesale investments, private market investments, direct stocks, ETFs, managed funds, term deposits, all in one wrapper without any paperwork or having to do any reporting, and all the reporting's done for you. And that's that kind of middle ground. They have a platform fee. As normal, there's always, there's three types of advice fees. I'm doing this at the moment. Admin fees, the cost of having an account. There's investment fees, the cost of the investments, and three, the advice fees. So, and the admin fees differ between each of them. So that they used to be expensive and limited. They've evolved a lot, and you probably would have seen that too in the last 15 years. True competitors to SMSFs. Yeah.
I think we've had that, we kind of went through those glory years of SMSFs where people would set them up, their advisors would set them up, and sometimes people didn't need them. So there's so many, 660,000 SMSFs in Australia now. And then it went through a period where people were like really unsure about it. And then all these technology platforms have come along, like even some of the online brokers and that sort of stuff, and help people set up an SMSF. Obviously, it's in their benefit for them to set that up for you. But I think we're going to see more people take control of their SMSFs, because I think the government's opportunity to kind of crunch the SMSF sector to say no more of this has that opportunity is gone, because there's just so many people that use SMSFs and will continue to use SMSFs because they want more control, because they don't trust big super funds and all that sort of stuff. So I think we're going to see more money being managed, even if it's not like fully SMSF, as you mentioned, but like hands-on, like SMSF light is what I like to call it. There'll be a lot more of that. I think the rules always apply, like for my type of people that, like me, if you're still working, you've got a family or you've got a mortgage, do not change super funds until you speak to your advisor and get insurance advice, because, we're all bulletproof until the next, diagnosis comes and all of a sudden you're up shit creek and you haven't got insurance to save you because you changed super fund. Do not change super fund until you review your insurance. At least keep the super fund until you get the new super fund and you get your insurance done. Like, you can open a new super fund and keep money in the existing fund that's paying for your insurance while you sort out your insurance. Like, just keep that in mind. That's a good question. Now, we do have some questions that have come through, as always. We don't know your personal circumstances. If you want personalised advice, you should speak to a financial planner, like, say, Drew. You can also follow the link in your YouTube description or in your podcast player that says financial planning. You can get matched with a financial planner. We actually have people that go through that matching service on our website just to see who they get matched with, but then they can tick a box which says, do you want the introduction to be made? And they say no. They actually just go through it just to see, and I had one fella who I got matched with you, Drew, and I was like, are you sure you clicked the right box? Do you want me to connect you with Drew? And he's like, no, I was just checking him out. And I was like, okay, no worries. As you were. But we don't know your needs, goals, or objectives, so be sure to speak to a financial planner before you act on the information that you hear in any Rask podcast. Even if it comes from someone who is licensed to give you personalised financial advice, we simply cannot do that through a podcast. And if we do mention super funds or insurance or ETFs, managed funds, so on and so forth, be sure to read the product disclosure statement, or PDS, which is available on the provider's website. First question comes from, I think this person's written in before, Value is Dead, Long Live Value. They say, hi guys, enjoying your deep dives into property investments, very informative. I recently invested $2,500 in a share purchase plan for SRG. It turned out to be 10 times oversubscribed, so only received $47 worth of stock. I did leave paying the above amount right up to the last 10 minutes before it closed. My question is, as far as you know, if you subscribe early rather than later in my case, would I have received more shares in the purchase plan, or is the timing relevant? So basically, for folks who don't know, sometimes companies do a capital raising and they offer the existing shareholders the opportunity to buy some shares. And normally for everyday investors, it's capped at $15,000. Sometimes it changes, and sometimes you can give up your right. You can sell your right to another investor and they can take up the opportunity to buy the shares. Those are the best ones. They're called renounceable rights issues. But in this case, they've said you can buy shares, and this person's put in $2,500. I said, I will buy $2,500. And the company turned around and said, whoa, we don't need that much. We'll give you $47 worth. Drew, would it have been different if they said at the outset, here's $2,500? Would it have changed the outcome?
No, not in this case. And this is why when we're advising on this, we're always looking for like a 10% discount to the share price if we're going to do a share purchase plan. And we always hold on to the last minute before putting your money into it, because otherwise it sits in a bank account and earns interest to someone else generally. But basically they sum all the money they get together and work out, what's fair between all those retail shareholders. Institutional shareholders obviously get as much as they want. But for retail shareholders, they just get a prorated amount of their shareholding and how much they requested. So it doesn't matter at what point.
Yep. Okay. So while you're getting some texties there, it doesn't matter. There are many different styles of capital raisings, but if you go into the offer document, which will be sent to you, you get a sense of what's happening. Drew's getting some Drew's in the DMs over there. Say, hey, when you come and join me in the spa?
It always happens.
Next question was written by Jade, who wrote in and says, will Rask offer a tax course in the future? I would love a Rask education course on explaining the tax process and how to maximize returns. Jade, two resources. We already have a tax basics course, so that's already free. And the way we designed that course is you could take it in 90 minutes and you get basically everything you need to know about like the essentials of tax. It won't tell you exactly what you can deduct, but that's where a good accountant comes in. So go and head to the Rask education website. That's education.rask.com.au. Obviously, they're all free, so you can go and check that out. The next question comes in from Too Big to Flail. I think I've written it before. It says, if I'm aiming to buy a home in the next 3 to 5 years, should I save and invest equally, save more of my disposable income, or just save 100% towards a house? So basically they're asking the question, should I still be investing, or should I just put everything towards savings, Drew? Because this is a common question for younger folks in particular, or even older folks that are saving up for a home. Hey, you guys say don't invest money that you might need for a deposit.
And it's pretty simple. If you've got a specific need, have an investment that's within 7 years, or within, in this case, 3 to 5 years, and you're going to need as much of that money as possible to put a deposit down, it makes sense to just be allocating towards that purpose, not to, as soon as you put it in shares, we know that, shares have averaged 10% per annum every year, but they've also had years when they're down 25 or 30%. If that happens in the next 3 to 5 years, well, you're not going to be, set your deposit back by another 3 to 5 years. So, and this is particularly relevant now that you can get a high interest variable account or a term deposit at 4 or 5%.
Yeah.
So in this case, keep it simple. You've got a very specific goal in mind. Don't mess with that goal, and just pile it away into savings and benefit from interest rates where you can. It becomes more of a difficult question when interest rates are zero, but we haven't been there for a while. Then my answer is the same.
Yeah, I think it's like 5 years ago, first home buyers were just watching property prices skyrocket, the stock market skyrocket, and getting close to zero for their term deposit or their savings account. So it was a horrible place to be. And now at least you've got some interest to keep you company. So that's a good thing. The other thing I would say is look at the First Home Super Saver Scheme, or FHSSSSSSS, because that is a way for you to use super effectively to fund your first home deposit. And there are a lot of T's and C's. Like one of the big risks is that you put money into super and then you're not allowed to withdraw it because for some reason you might meet a partner who already has a house and you can't buy one together and the super fund won't release it or the ATO won't approve it, those types of things. But if you go through the FHSSS process correctly, you may be able to get, 30 grand out of super, maybe a little bit more. So that can help to boost your super, to boost your deposit. Drew, we've got a couple more questions here. Pete Rabbit writes in and says, best way to managing large amount of cash. Would love to put it all in stocks or grow it through savings account. What would be the best option for most tax effective? Basically, they're open to investing. Got a lot of
cash. Well done. Whatever the cash has come from, inheritance, property sale, whatever it happens to be. I mean, if you're investing a large amount of cash, our view is different. If you're rolling it from something that's already been invested in share markets into another investment, you just invest it all straight away. If you're going from cash to something, and if you haven't had a lot of experience before, then I'd be combining both. I'd be holding some in savings and then slowly adding it, dollar cost averaging or even dollar cost lumping. That's a new word. Over a 6, 9, 12 months or even more longer period, depending on your comfort. And that just reduces the risk that you have a negative experience in the first 3 months that set you off your course. Part of that's the behavioural side. And you could miss out or gain returns by being invested more during that period. But I think it has to suit the experience and risk profile of the person and what they're comfortable with. In terms of tax effectiveness, this is probably a broader question. If you're in the right age group, the most tax effective structure would be superannuation. If it's accessible and if you're nearing that part of your life, then that would be the first step. And then you start dialing back from there. If you have a high taxable income, you look at things like family trusts or companies to put it in, or you could just be investing it in your own name. And then tax effective, you can go down to the investment level. Fully franked dividends give you a bit of a free kick. The franking credits are refundable. ETFs and managed funds will distribute all capital gains to you so that you can't really control tax on them as well. But I think the short story there, the short answer to my long explanation would be you want to build a strategy and a framework around it that you can follow over a long period of time.
I love that word, that phrase, dollar cost lumping, or DCL, which is Drew's new term.
Always a new one.
Well, yeah, Dr. Andrew Derrymouth would be proud of that one. So DCL, dollar cost lumping, I think that makes sense. I think one thing that doesn't make sense is when people now think that it's risky to put all their money into their investments in one go. I think that's because people still believe that there's only two things to invest in, cash or shares. Like in the past, you would go stocks, cash. Now, thanks to ETFs, like even active ETFs that are available through your brokerage account, you're not just building a stock and cash portfolio. You've got bonds, you've got global bonds, you've got global shares, you've got Aussie shares, you've got emerging markets, you've got gold, all in one place. So, yeah, you can just put it straight into a diversified portfolio. But the reality is, Drew, I keep coming back to this, is that it comes down to how you behave. And if you're not going to, if you're a new investor, do not invest it all at once. Just break it up into little pieces. And I like that idea of having a strategy, mate. So I've got a couple more quick questions here. One come from Stonk Sultan, which is a good name, to be honest. And they write in and said, I am almost ready to begin investing, and I'm trying to figure out if it would be better for tax reasons and for growth to start investing in dividend ETFs such as VHY, which is the Vanguard Dividend ETF, compared to the all growth ETF. I feel like the dividend investing would help grow your investment due to the dividend reinvestment plan or distribution reinvestment plan, then dollar cost averaging. I'll jump in here first, potentially. I think there's a bit of dotting your I's and crossing your T's that needs to happen here just to understand how this actually all comes together. A dividend reinvestment plan takes the growth, some of it at least, and then just reinvests it. Dollar cost averaging is a different thing because you're taking external funds from your salary or from some other source, like from property, rental income, whatever, some other source, and you're adding it to the investment. Whereas a DRP is kind of just like recycling the same investment. So it's a little bit different. In an ideal world, you should be doing both. So in this instance, does VHY, the essence of this question is, do dividend companies grow faster than normal everyday, stock market indices, I guess?
No.
No, but
you can DRP with growth ETF as well. What you're likely to see though is you get a bigger distribution and small capital growth, and then you choose to reinvest that where you want to. I think in our setting is always cancel DRPs because you just end up buying more of the same companies at the same time. And I don't think the big one here would be, I don't think it's arbitrary. It's not one or the other. Any good portfolio should have income plus growth to get your total return.
Sounds like a golden rule. Where's my book?
Just don't think you should be choosing one or the other. And history shows investing companies that pay out too much of their profit as income never grow. So you end up having something that just keeps paying. You cap returns capped at your income, whereas growth, we've seen what companies like Apple, Microsoft can do. They go up 100,000% over 3 years.
We've got VHY in our retirement portfolio because retirees benefit more from the dividend nature of VHY with the franking credits, whereas with VAS, which is the broad Vanguard fund, or A200 or STW IOZ for anyone else that's in those ETFs, effectively the return looks the same. If you go to the long-term total returns, dividends plus growth, the returns from all of them look very similar, maybe with some very slight differences, but that doesn't include the benefit of franking credits. So retirees who are happy to pay more for a portfolio that turns over more often because they don't pay tax should consider VHY pretty strongly, or related dividend ETFs. Final question from failed property investor who has written in before. It says, "G'day gurus, mustn't be talking to us. I'm 42 and I want to retire in say 20 years. Super's on track, all that sort of stuff. They say, but my mortgage will not be repaid until I'm 67. To meet the goal of paying off the house by 60, I would need to pay an extra 10k per year on the mortgage. I am considering salary sacrificing 10k into super to take advantage of the tax breaks instead, then paying off the mortgage with a lump sum upon retirement. Would love to hear the pros and cons of this strategy." They say, "PS, sold the apartment, massive weight off my shoulders." I do remember this questioner who sent in this question. I think it was Chris and I that answered the question, Chris Bates and I, and they talked about their apartment and what they could probably do with it. And I think Chris's advice is kind of like, it's probably not a good idea to keep it. So I'm glad that's a weight off your shoulders. But Drew, they've got they've done the maths, and they're like, I'm going to hit retirement and I'm probably still going to have a mortgage. So I could start paying it off now, or I could put more money into super, claim a tax deduction, build my super nest egg, and then just pay it off. Thoughts?
I mean, it's worth considering, do you think you're going to own this house for another 18 years?
Yeah, that's a good point.
And it's always, we think in arbitrary terms that we're going to hold this house and we'll pay it off the mortgage at the end. But most people turn over their houses, 3 or 4 times from at least 40 onwards. If you've got kids, then your kids grow up and a lot of that can happen beforehand. So the first one is, don't assume that you're going to own the house. And then that could free up capital quite significantly. You clearly have equity in it, so it can free up capital quite significantly. And I think we generally look at using super to pay off mortgages where someone, I think, generally has a lower asset base, if that makes sense. So in this case, and it probably changes now, the interest, most mortgages are like 6.2, 6.5%, that there is a benefit in aggressively reducing that mortgage and then using something like debt recycling.
Oh, you took the words right out of my mouth.
And you can go, I'll hand over to you for that one.
No, well, yeah, I was going to say, depending on their risk profile.
Yeah.
So, I was in touch with Dom from the Fairfax today. Actually, I was asking about this. It's one of the most topical things in our community right now is using debt, turning non-deductible debt into deductible debt, and by investing it. So doing like an equity release or something like that from your mortgage. So basically debt recycling is taking a loan that's currently in your mortgage on your property, redrawing more money so your loan goes up, and then using those proceeds to go and invest in something. Now, traditionally, that was most often then used to buy another property and another property and another property. But I think many in the Rask community, and I think in every community going forward, will not be using property. I think that the majority of really smart Australians who understand debt recycling will now be using ETFs and like broad share market portfolios to do debt recycling, because I think they'll realize it's simpler. They get franking credits. it's easier than having an investment property, especially with all these bloody land taxes. Like if Victoria's put in all these land taxes, everyone's going to do it. Like Victoria was just the first one. They're all going to do it. It's too good for the state revenue office of every state to not do what Victoria's done, in my opinion. Like New South Wales has already started doing it. Like everyone's going to do it, Drew. So debt recycling, that adds debt while because you're maximizing your borrowing capacity in order to then invest. But the idea is that the investments grow faster than the interest that is tax deductible. So then when you get to retirement, you can pay off the existing loan using the share portfolio, the ETF portfolio. Now that's not personal advice. It's just general for anyone that's listening.
You can find that. Yeah, you can find examples that online too quite easily.
Yeah. So it's basically, it sounds counterintuitive because you're kind of like taking on more debt so then you can pay it off quicker. That doesn't make sense. But basically, because the investments that you make, assuming that you're a long-term investor, assuming you've got a high-risk profile, assuming you're sensible and you're not just going to blow it up, and you get advice from a financial planner and your tax agent, assuming you do all those things, it can actually supercharge your wealth, and then you use that to pay off your mortgage sooner. That's it. So, Drew, I have to pick a best question to name, and you, good sir, have to give us a dad joke to send us off into the sunset before you go and jump in your jacuzzi. They always freak me out. I don't even know if you're going to jump into a jacuzzi. I'm just assuming that that's what you're going to be up to. But I'm going to pick the question. I just love the roundabout failed property investor. I love that you asked this question about whether to use super to pay off the mortgage or pay off the mortgage then add more to super. Either way, it sounds like you've done the calculations and you've sent in another question. So good for you. Just send me an email, send me the team at Rask an email, and we'll give you the Value Investor Program worth 499 clams for free. So that's all yours. Drew, what have you got for us, mate?
Yeah, this one's going to be a shocker, to be completely honest. And that one is, which days of the week are strongest?
Wait.
Saturday and Sunday, because the rest are weekdays.
Oh, Jesus. Oh, that's actually pretty good, mate. The simple ones get me. That was a good one. I'll give you a 7 out of 10 for that. That's not bad at all. In other unrelated news, we've had we may be able to get the CEO of Zipco on the.
I'm excited for that one. I got that news last night.
So we've got an open line of communication. Zipco, if you're listening, we would love to get you on.
Come on.
We want to get some stock price predictions. I've got a friend in need. If you want us to speak to any of the CEOs or anything like that, just write into us. Let us know who you want to speak to. If you do have any questions, be sure to send them in via the Ask a Question link in your podcast player, or simply head to community.rask.com.au. You'll also find the links through to that on the Rask websites. From there, you can put questions in the retirement, the property, the personal finance, behavioral finance channels or spaces, and you can get answers to questions and see what the community is saying. And finally, if you want financial planning advice, go to the link in show notes that says financial planning. Even if you don't use one of our financial planners, on there at the bottom of that page, it has a checklist for getting a financial planner. We've had so many scams, so many fraudsters, so many dodgy people pretending to be advisors, and people think that they're dealing with advisors, but it's because they haven't followed that checklist. Follow that checklist, and you'll be able to verify the financial planner is legitimate and registered with ASIC, our regulator, and so on and so forth. So Drew, from Model Partners, as always, buddy, thanks for joining me.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.